Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to talk about how to retire tax-free using annuities. In this video, just a disclaimer, these are all very high level and we won't go over specifics. You'll have to contact us for your specific scenarios so we can create a case design for you. But we want to get your brain going on ways to do one of two things. Number one, retire tax-free using annuities, or reducing your tax bill in retirement using annuities. Okay, so I'm just going to talk about a couple of ideas for you to think about, and then you can contact us and we can put together a case design for you. Okay, so first way to retire tax-free using annuities is roll over or transfer your Roth accounts, Roth IRA, Roth 401k, etc., over to a Roth IRA annuity. And you're able to get tax-free gains or tax-free income for life using the Roth IRA annuity. Now, you have to follow the same rules as the IRS, which is you have to be in that Roth account for at least 5 years, and you have to be over 59 and a half to start taking withdrawals. Once you do that, you're going to get tax-free income and tax-free gains going forward, okay? If you've owned a Roth IRA in the past, as long as it's been in there for at least 5 years, you shouldn't have to wait for the 5-year period because it's already gone past you. So just know that, okay? So if you're looking for growth using an annuity, you can buy a fixed annuity, which earns a fixed interest rate for a fixed period of time, like a CD would. You can use a fixed index annuity where you earn interest either by a fixed interest rate that changes annually, or you earn interest based on a stock market index like the S&P 500, NASDAQ, Dow Jones. No, you're not in the market. The insurance company uses those indexes as measuring sticks to determine how much or how little interest you earn each and every year. So if you want to be getting some sort of returns based on performance, you can without the hassle of losing money to a down market. And then there's a variable annuity where you're actually in the market and you can lose money that way as well. So those are the three ways to grow, okay? As long as you follow the IRS rules, those gains that you earn from those three vehicles will be tax-free after the IRS requirements are met. If you want to roll over an annuity from your Roth account for lifetime income, as long as you've hit that stat, those requirements, you get tax-free income for life. Okay, so you could do those two options. And this is the cleanest way to do things. So we're going to start going into other methods that will essentially get you close to tax-free or will reduce your tax bill. Okay, so second way is doing a Roth conversion. You could do a Roth conversion either in a lump sum or over a period of time. So do it gradually, okay? And you can use a bonus annuity, which is a fixed index annuity with a premium bonus. Think of it like a sign-on bonus. You buy this contract, we're going to give you guaranteed money or guaranteed interest on your account as long as you follow the terms and the conditions of the annuity, okay? And right now, I think it's up to a 29% bonus. And the idea is this, that the bonus softens the blow on the conversion because you're going from tax-deferred vehicles to tax-free. So you can't instantly make your money tax-free without paying taxes on the tax-deferred amount, right? So the idea is the bonus softens that blow. If you do it in a lump sum, we typically recommend to do the conversion where it's at now, then roll it over to the Roth bonus fixed index annuity, and then let it sit there for 5 years to get that, Roth IRA tax-free status. And then the bonus and the interest that you earn along the way will go from taxable to tax-free after the 5-year period, and assuming you're over age 59 and a half, okay? The other option is you don't convert it where it's at. You roll it over to a bonus fixed index annuity, and then you get the bonus. And then what you'll do is you look at what your tax bracket is. So let's say you're in the 22% tax bracket as a household, and whatever money, this is what most people do, whatever money between the money that you bring in as a household income that could be taxed, and the amount of money to just under the next highest tax bracket, so which is 24%, you would take that difference and you would use that to convert on an annual basis. This way, you're still in the 22% tax bracket, and you're slowly converting it over a fixed period of time. And after that fixed period's up, then everything turns into tax-free, and then you're good to go. And now you have tax-free retirement, okay? Some other ways to lower the tax bill. If you had a taxable income and let's just say you're getting towards RMD age. At age 73, you have to start taking money out of your tax deferred accounts and start pocketing it and paying taxes on it per the IRS. You could take $211,000, and you could put it in what's called a QLAC, which stands for a qualified longevity annuity contracts. Sorry about that. It's a tongue twister. And basically what the IRS says is you can put it in this vehicle and you could defer the RMDs until age 85. So if you want to keep deferring the taxes, you can. Okay. So that's one method. Another method, if you want to retire early, is you could take after-tax money, cash basically, buy a non-qualified life-only SPIA, and you could get guaranteed income for the rest of your life. There'll be some interest baked into your paycheck that you get from that SPIA. Think 1 to 1.5% interest is usually the interest amount that you're going to get, right? And what you're going to want to do is you're going to want to take the amount that you purchase the annuity with and buy a separate 20-year term life insurance policy, because it's low cost. It's the cheapest. And the 20 years, you should get your original principal back. But the idea is with a life-only SPIA, you die, the insurance company keeps the rest of the money, right? So there's no death benefit, okay? And why you would do that is it would be the way that you would skirt the IRS 10% early withdrawal penalty, right? So usually with retirement accounts or annuities, you have to wait to age 59 and a half to start taking income and not get an early withdrawal penalty from the IRS. If you had cash, you could fund let's just take $1 million SPIA. We take $1 million SPIA and you're going to get a little bit of 1.5% in interest baked into the payment. And then you'll pay ordinary income tax on the interest amount that's built into the paycheck. And that'll come out proportionately. So your paycheck will be a split of taxable income. That's the interest that you've earned in there. And you don't have to pay a 10% early withdrawal penalty on it from the IRS. And then the rest of it, you don't pay taxes on. Okay. And then you can get this for the rest of your life. So let's just say you're in your 30s or your 40s or in your 50s and you want some sort of safety net to guarantee that you're going to get this income as a floor no matter what. This is what you would use. And then you would go and buy a $1 million 20-year term life insurance policy. And this way, if you get hit by if you get hit by a bus in year 5, and the insurance company keeps your $1 million from the SPIA, that it triggers the life insurance proceeds, and then the $1 million goes down to your beneficiaries in a lump sum, tax-free, right? So it's kind of a safety net to a safety net type of deal. So you could do that. If you have non-qualified annuities already, or cash value in a life insurance policy, you can, the way that works on non-qualified annuities is your original principal has already been taxed, so it's not going to be taxed again, right? But any gains you receive on that life insurance cash value or that non-qualified annuity, it's all taxable as ordinary income, right? So let's just say you're older and you don't need the money, but you're worried about maybe going into a nursing home or home health care or assisted living, which is a ripoff and will make you broke real quick. You could 1035 those non-qualified funds into a long-term care annuity or a long-term care life insurance policy. And then you could utilize the long-term care benefits, in most cases, a tax-free manner. And this way it keeps deferring the taxes, and then you ultimately get to use a tax-free benefit towards things that you're probably going to have to use. I mean, the government says if you're over 65, you have a 70% chance that you're going to end up in a nursing home or need assisted living or home health care, right? And those things are awfully expensive. I mean, disgusting expensive. You go to a nursing home, man, it's going to cost you $100,000 a year to go to a nursing home and be in a private room. Okay. Doesn't matter if you're poor or rich, $100,000 a year goes through quickly, right? So that's one way. The other way is if you're wealthy and you've got money in non-qualified annuities, you can, what you could do is you can keep moving money into other non-qualified annuities, all right, between spouses, and to keep deferring the taxes, and then let the beneficiaries take care of the taxes. I mean, they're not going to argue on an inheritance in most scenarios, right? So the idea is this. Let's just say you have $500,000 in cash. You buy a $500,000 non-qualified annuity. That $500,000 grows to $1 million. That $500,000 in interest is all taxable. But guess what? You get to keep deferring it as long as you want. You die. Your surviving spouse picks up the contract through spousal continuance and continues to defer those taxes because she can continue the contract as if you were still alive. And she does it till she dies, and then whatever's left goes down to the beneficiaries, and you can structure it in a way that kind of minimizes their tax liability. So yeah, that's another way that you could do it. Another way, this would probably be the final tip that I give, is if you've got qualified accounts early on, if you can fund a permanent life insurance policy, you could take the money from qualified accounts, pay the taxes on it, put it in a permanent life insurance policy like an index universal life or a whole life policy, let the cash value grow, and over time, you're going to be able to take tax-free loans from it. So as that cash value in the account, it's kind of like a savings account, grows, you take loans against it, it's considered taking on debt, and it's tax-free, and then you kind of spend it down that way too. So that might help offset some taxes over a longer period of time. Now, these are just high-level ideas to get your brain going. If you think any of these ideas could help, you could come to the Annuity Expert. Just go to Google, Yahoo, Bing, type in the Annuity Expert, and we'll show up. And then what we could do is we could put together a case design and show you some options to do this. It's no obligation, no sales pressure. And if it's something you want to do, great. We'll sell you the annuity or life policy or both. If you don't want to do it, well, you've gained some knowledge, and no harm, no foul. So hope this helps, give you some ideas. If you've got questions, come to us, email us, we'll answer the questions. You can leave questions in the comments and I'll answer them. If you're looking for a case design in the comments, I won't do that. You have to come and talk to us about that. But I'll answer any specific questions that you have. And then like, subscribe, and we'll catch you on the next video. See ya.